succinctly.
Welcome to The Close. Romaine Bostic here alongside Katie Greifeld. We're watching President Trump right now at the White House. Alongside him off camera is Michael and Susan Dell. Of course, Michael Dell, the founder of his Epinus computer company, pledging to give more than $6 billion to fund accounts for children 10 and under. Let's take a listen as to what Michael Dell has to say.
That's fantastic, Susan. These gifts will be available to the first 25 million children aged 10 and under the zip codes where their median income is $150,000 or less. So they're giving them to children that won't be born particularly rich, and they're going to be hopefully very rich someday. This will give millions of dollars, millions of children, middle-class families a stake in American prosperity, a benefit from the rising stock market, and a better shot at the American dream. It really gives them a shot at the American dream. Michael and Susan, I want to thank you for this extraordinary act of kindness and patriotism and charity. This is truly one of the most generous acts in the history of our country. I mean, you don't hear about things like that, and we got to let people know he doesn't want and she doesn't care about that. But I do. I think when somebody does that, you got to let them know about it. As I mentioned, this gift is being made possible by the largest tax cuts in American history, which our Republican majorities passed earlier this year. And the Speaker worked so hard, and John Thune and Jason and all of them, every one of them. Ted Cruz is with us. He worked so hard getting that done. That was the biggest, most consequential bill they say ever passed. And, you know, if they remember, Michael, they thought we had to put that in 12 to 14 bills. I said, I don't know if we can hold it that long with the Democrats. And we said, let's try doing it once. So we did, and people were surprised, but we got it done. So I congratulate you guys. Amazing job. Under that bill, the federal government will also automatically be making a one-time seed contribution of $1,000 into the tax-deferred Trump accounts for every newborn U.S. citizen, fulfilling a promise I made in the 2024 campaign. Trump accounts should grow to be worth many thousands of dollars by the time the child is 18, and even more by the time they are 20 or even 30 years old. We think it's going to be something really unique and really special. We hope many others will follow Michael and Susan's example and make their own contributions. I'll be doing it too, to the next generation, including businesses, churches, philanthropists, family members, and parents themselves. I think we're going to have a lot of people, Susan. I think a lot of people are going to be contribute. A lot of people are watching us right now. They might not be $6 billion plus, but there'll be a lot. There aren't too many people that are in the $6 billion range, but there'll be a lot. A lot of friends of mine have already told me they're going to contribute a lot of money, and a lot of them are going to leave a lot of money in their wills, so that's very important. And as you watch us today, I hope you'll be doing that. Contributions to Trump accounts will also be a great benefit for employers to offer their workers, which they'll be able to do tax-free. It's tax-free. We expect hundreds of major companies to announce plans to contribute to these accounts in the coming months, and we've had tremendous interest in that regard. So the Trump accounts will be available starting on July 4th of next year. And Michael and Susan, to you again, it's an amazing act of just incredible everything. I mean, the life you've led to be able to do this, even to be able to, a lot of people have a good heart, but they can't give $6.25 billion. And Michael, probably knowing you, it's not the last of it either. It's not the last. But on behalf of the United States of America, I want to thank you both, and I want to thank all three. But I want to thank you both because you've been friends of mine, and it's a spectacular couple. This is really an amazing people. These are unique. And I'd like to have you come up and say a couple of words and tell us what you have in mind, because what you have in mind is good. Thank you very much. Thank you.
Thank you, sir. Thank you, Mr. President. It's a great honor to be with you here in the White House. And, you know, when you passed the Invest America Act on July 4th of this year, we were really inspired to see that happen. And this is something that, you know, Brad had first mentioned to us in 2021. We thought it was a great idea then, and it's amazing that it happened. And we also saw that this act would become a platform. And we believe the smartest investment that we can make is an investment in children. And this act has created a platform for families and friends and communities and companies and philanthropists to contribute to these accounts to create a savings and opportunity and hope and prosperity for tens of millions of children in this country. And Susan and I are super excited to announce our $6.25 billion gift to 25 million American children, 10 and under, and our gift will cover most of the children that are 10 and under that are not part of the federal program, the 0 to 2-year-olds, and who also live in zip codes where the median income is $150,000 or less. And I have spoken with a number of other wealthy Americans, philanthropists, and we are confident that others will join us because we all understand the incredible impact that a gift like this can have on the lives of young Americans. So again, it's a great
And right
honor
now,
for
you're
us.
listening to Michael Dell, of course, the co-founder and head of Dell Technologies, speaking at the White House right now about a more than $6 billion gift that he's pledged to fund what are effectively going to be investment accounts for newborn children here in the United States, going to be dispersed in the hundreds of dollars range per person here. If you want to continue listening to this event at the White House, you can type live go on the Bloomberg terminal, or even better, you can keep watching this show because we're going to have an interview, Katie and I, with Michael Dell a little bit later here in the show. This is The Close right here on Bloomberg, and we count you down to the closing bells, 3:07 p.m. roughly here on Wall Street. Katie Greifeld, and a bit of a turnaround from what we saw yesterday. The market, I guess, cautiously optimistic, we can call it?
Yeah, we have a little bit of a rally to talk about. I stress a little bit, but certainly better than where we stood this time yesterday. The S&P 500 higher by about 0.9%, being led by big tech, as you can see, with the NASDAQ 100 higher by nearly 1%. I threw out Bitcoin because, boy, what a turnaround we're seeing specifically in the world's biggest cryptocurrency, back above $91,000 per coin, closing in on $92,000 per coin, up about 6%. The bond market,
I would be more impressed with that if I hadn't bought in at $110,000. But
yeah,
I get your point.
There's probably still a lot of people underwater. But also the bond market, the fact that it's not really doing anything, also interesting in and of itself.
Absolutely, and we should point out a lot going on here today as the market really does keep an eye on economic conditions, of course, on what's going on in corporates, but also the idea that a lot of the moves that we've seen in this market over the past few weeks has been more technical than fundamental. Mandy joins us right now around the desk, head of derivatives market intelligence with CBOE Global Markets, to kick us off to the closing bell, a belated kickoff to the closing bell. But Mandy, always great to have you. And maybe you could kind of make sense of what actually transpired over the last couple of weeks, because we had that big rally at the end of November, which I'm told was a little bit more technical, maybe some short covering, maybe some profit taking, some other things. Yesterday was kind of a weird day. And then today it looks like the market now seems to think, okay, let's resume this rally with the idea that the Fed will be cutting rates next week and corporate fundamentals are holding up and AI is still, eating the world.
Yeah, I think what we've seen over the past month is a shift away from looking at earnings and fundamentals to more the macro picture and specifically the Fed, right? So we've really kind of done a V-shaped recovery. First, the sell-off on the back of pricing more hawkish Fed, and now with the rebound as people resume kind of expectations of the Fed cut. So if you look at the probability of a Fed cut next week, it went from almost certainty until like 30% probability a month ago to now back to like almost certainty again. So I think that kind of explains a lot of the market action that we've seen. But in the options market specifically, I would say the shift in activity has been away from single stock options, more to ETF and index options, and that typically happens when there's more of a macro focus in the market, people looking for that macro macro exposure.
So you think that is the more the focus right now than maybe what we saw a month or two ago?
Exactly. And specifically within the equity market, I would say it's all about tech, and where tech goes, the broader market goes. So you've seen, obviously in the sell-off, a huge bid to the volatility of the tech sector, QQQ volatility trading at a one-year high relative to SPX. That's starting to normalize a little bit, but it's still very elevated. So I think that's going to be a point of focus within the equity market.
So you talk about, this macro umbrella, you have tech under it. You also have the Fed decision under it, I would imagine, coming up next week. What does activity look like there? Because now it seems like the market is back settled, that the Fed is going to cut rates, but we know that has been a hot topic.
Yeah, sure. I think the market's going to be in a kind of a holding pattern until that Fed meeting. Right now, the expectation is that the Fed will cut, but certainly I think the language and the forward guidance is going to matter a lot. In the volatility space, what we've seen in the option market is a bid to protection. So we've definitely seen a notable increase in hedging demand in all of the major indices, whether you're looking at SPX or QQQ or Russell, the small caps. So that's been a theme, is people looking at just the forward outlook, the uncertainty with regard to the Fed policy and just the broader macro environment, and also kind of the great run that equities had year to date, and really trying to lock in those year to date gains going into the last month of the year, where typically liquidity may not be as robust, where you might be more vulnerable to a pullback in the market.
I'd also love to hear your thoughts on what we're seeing specifically in the digital asset space. You think about Bitcoin, the volatility that we've seen there, obviously enjoying a bit of a bounce back today, but we know that that's the anomaly. How are we seeing that expressed when it comes to the option market? What does that say about sentiment going forward?
Sure. So what we've noticed, actually, it's an interesting story throughout the year, is that as Bitcoin ETFs and Bitcoin options become kind of more mainstream, the volatility dynamic around the Bitcoin ETF options have become also more like equity-like or traditional asset-like, in the sense that when you have the pullback in Bitcoin, volatility goes up. The negative spot vol correlation. When Bitcoin sells off, you see higher levels of skew, more demand for protection. That's actually not typical for crypto, and that's very much in contrast with, for example, what we're seeing in gold this year, which is volatility actually going up as gold prices rally, and when gold pulls back, as it did in October, we actually see more demand for upside calls. So it's definitely been a contrast between the digital gold or the crypto assets versus gold this year, and definitely more demand for protection as the asset becomes more institutionalized and more mainstream.
All right, Mandy, unfortunately, we have to leave it there. Great to get some time with you today. That is Mandy Zhu. She is Vice President and Head of Derivatives Market Intelligence with CBOE Global Markets. Now let's narrow our focus from the broader markets to one single stock, Amazon. The tech giant hosting its annual Amazon Web Services reInvent conference down in Las Vegas this week. The cloud-focused confab draws developers, engineers, and other thought leaders in tech to explore the latest cloud and AI projects happening under Amazon's roof, including a new AI chip. Let's go live now, where Bloomberg Tech co-host Ed Ludlow is joined by a special guest. Ed, take it away.
Yeah, three pieces of news moved markets this morning. A new generation of frontier model from AWS, new agentic tools, and then a very quickly released, installed, and now ramping generation of in-house custom accelerator, which is Trainium 3. All points of discussion for Matt Garman, AWS CEO. The basic point with Trainium 3, and you've moved quickly to bring it to the real world, is cost, performance, efficiency over the prior generation, but also over NVIDIA GPUs, over Google TPUs. I think what people are trying to understand is that ramp part I was talking about, when real world customers use it beyond this anchor customer of Anthropic, which relies on it currently.
Yeah. Well, look, we're quite excited about Trainium and Trainium 3 in particular, as you mentioned. Excited to get it into customers' hands. And part of where we have a benefit that we can bring to bear is, as you mentioned, getting it into market quickly. And it's because we control that full stack. We control the silicon development. We control the data centers that it land in. We know that full environment, and we can land that in very large clusters for people to take advantage of that. And the performance that we're seeing out of it is quite incredible. And so we're anxious and excited to get more and more people using it.
I've been able to go inside Annapurna Labs and look at the engineering work between the first generation of Trainium and the second. It wasn't just the accelerator, it's at the server level as well.
That's right.
But part of the surprise of today is this: you appear to be committing to an annual cadence of new generation of Trainium. How do you keep that up?
Well, the key thing that we're focused on is making sure that we can iterate on the technology as fast as possible. The desire and the hunger out there for more power and more compute is almost insatiable. And so the more we can take an existing power footprint, an existing set of capabilities, and bring more and more compute into that for customers to build cool applications and cool environments, and to get value from that, that's what we're focused on. And so we're going to be pushing that envelope as fast as we possibly can to get those new capabilities out to customers.
The pitch for Trainium in both the training and inference use case is that it's a great deal. You know, cost effective, performant.
Yeah.
At the same time, you went on stage and said AWS is, quote, by far the best place to run NVIDIA GPUs.
Yeah.
How are both possible?
Well, both are possible because that is a great environment to run accelerators and compute in. And so we've been working for 15 plus years with the NVIDIA team and Jensen and team to deliver outstanding capabilities for our customers. And for when you're running a large cluster of NVIDIA GPUs, people will tell you AWS is the best place. You get the best performance, the most stable cluster, the best capabilities out there, and broad scale. And that's why folks like OpenAI and others are running in AWS. And we have that choice. And so for others that want to be able to take advantage of Trainium, and there's some use cases that are best for Trainium, there's other use cases where NVIDIA GPUs are going to be your best option. We want to have all of those available. And so we think that if we can continue to push the envelope on what Trainium can deliver for customers and make sure that we are supporting the latest and greatest from everything that the awesome team at NVIDIA is delivering, that's going to be the best outcome for our customers.
The plan for AWS is to basically double capacity by end of 2027 to around 8 gigawatts. Do you have a sense of how you apportion that capacity in-house silicon and server designs of Trainium versus NVIDIA GPUs?
We're just going to keep pushing as fast as we can, and we'll see where customer demands drives us as we go. And as you said, we're massively adding capacity. In the last year alone, we've added 3.8 gigawatts of capacity, and we'll continue to add more and more over the next couple of years. And we'll let customer demand drive us a little bit on what they're looking for and what they want. And that's what we always listen to, and that's what we'll continue to listen to.
The focus with Trainium in the time I've been able to interact with you and talk about, not just the accelerator, but at the server design level, there's a lot of benefit to the customer. When does that benefit start accruing to AWS in terms of profitability? Like if it's such a good financial proposition, you must be able soon to say we're making a lot of money on this.
Yeah, well, you're already seeing some of the benefits accrue. You see things like Bedrock growing really, really rapidly, and you see Trainium powering that under the covers. And we announced today that more than half of all tokens and inference done in Bedrock are done on Trainium 2 servers under the covers. And so you're already seeing that benefit come. You see the models that we're building in Nova and Nova 2 start to get better and better over time. And be accelerated by Trainium. And so we really think that there's a whole bunch of dimensions on which both our customers, our partners, and our own products are going to get accelerated, all from Trainium.
Every time you come onto the program, I always offer the audience opportunity to pose a question to you. There's a lot of interest in AWS, right? Many of your customers span global technology. Actually, most of the questions were about Anthropic. That wasn't much said on stage. I think people are trying to understand what is the benefit and advantage AWS offers to Anthropic while they are ramping Trainium through Project Rainier, but also ramping their TPU allocations as well.
Well, our partners at Anthropic, our partnership with them is incredibly strong, and it's never been stronger. And we do a ton of collaboration with them. And as I mentioned, through Project Rainier, it's a huge collaboration there to go build their current generation models. And all their models run today and launch on day one on top of Trainium and on top of AWS, which we're incredibly excited about. And we'll continue that partnership for a long time. I think from them, they have a huge demand for compute. And so they'll go to other places where it makes sense to round out their compute needs, because they just have such massive needs for compute, and they have customers in other clouds as well. But we're definitely their primary cloud provider and closest partner for sure.
Supply constraints. So Anthropic is supply constrained. They can't get the compute they need. We've talked about the ramp on NVIDIA GPU and in-house silicon. Is there a supply constraint element with AWS? Are you able to get the chips that you need?
Yeah, I think there's always, anytime you see an industry that's growing as fast as this is right now, when you think about AI and model development and chips, there are going to be constraints no matter what. There is more demand than there is supply. Sometimes it's in chips, sometimes it's in power in data centers, sometimes it's in different parts of that. At some points it's networking equipment. At some point it's transistors, resistors, or whatever it is. And you look at the entire supply chain that is needed to ramp up at such a massive rate. Right, never before has the technology industry ramped at the rate that we are right now, and so that there are always constraints. And so it's not necessarily there is necessarily one constraint where it's like, wow, I can't get NVIDIA chips. We can get NVIDIA chips, and actually, Jensen and team have been incredibly supportive and great partners in helping us get capacity there. It's not that you can't get power. We're getting power all over the place, but it's just we're ramping all of these places in such rapid rates that always there's a constraint in that system, and it'll change every month. You ask me of what the current one is.
Throughout the day, we were just speaking with your team about the idea we're moving from AI assistants to AI co-workers, particular focus on the agentic offering that you've done. You're in the camp of people, if you don't mind me saying, that sees basically 90% of the value in enterprise coming from agentic technology. Do you have any data or evidence to support that all of your customers are ready for that?
Yeah, I don't think all of our customers are yet ready for that, but they're excited about it. So, I think it'd definitely be an overstatement to say everybody's ready for it. And part of that is because it is going to take change, right? People are going to have to change how they think about work. They're going to have to change their process flows. They're going to have to change some of the things about how they get work done. It's not just going to be a magic wand that's going to come in and magically get them to get value. But almost everyone that I talk to definitely sees that that's the path. The agentic the power of agents is what allows customers to actually get that work done. And when they see that efficiency gain, they see them able to accomplish things they weren't able to do before, that is when it's worth it to go make these changes. And so there's going to be work for people, and it's going to take some time, right? We're 20 years into the cloud journey, and still only a fraction of workloads have moved to the cloud. So it's going to take time. It's not like people are going to magically switch, and I think it's going to be really fast.
Matt, we just have 60 seconds. 20 years into the cloud journey, when I touch down in Vegas, everyone accepts AWS #1 in terms of scale infrastructure. They question, is AWS #1 in AI? Just in the 30 seconds we have left.
Yeah, I think it's a question that we got a lot 2 years ago and not that much a year ago. And today, I don't think we get that nearly as much. It's just people that are kind of playing the same tapes. We have a huge choice of models. We see when customers are actually moving their workloads to production, they want to run those AI workloads on AWS. And that, to me, is the biggest signal. When we see our customers, they say, I ran proof of concepts in a lot of places. When I want to move it to production, I want to run on AWS. And that's the thing that we hear over and over again, which makes me think we're actually in a great position.
Matt Garman, AWS CEO, with the full stack AI company pitch here in Las Vegas at reInvent. Back to you guys in New York.
AWS CEO speaking there out there in Las Vegas. Meanwhile, back here on Wall Street, a close eye on the market and a close eye on strategy. The shares rebounding today, up almost 8% here on the day after a more than 40% drawdown just over the past 8 weeks alone. A lot of questions right now about, well, whether this is the start of a continued decline or maybe just a temporary setback. Let's get right to our next guest. Joining us right now, Mark Palmer, Senior Equity Research Analyst over at the Benchmark Company. He just reiterated his buy rating on the stock. I guess some reserves, giving some investors maybe a little bit more comfort about some of the concerns about the drop that we've seen in Bitcoin. What do you make of it, Mark?
Well, first, thanks very much for having me on. I think that what we have seen with MicroStrategy is a massive overreaction rooted in the fact that many of those who have been casting aspersions on the company and the stock are not very familiar with its capital structure or the mechanics of its business. The reality here is that this is a company that has upwards of $59 billion worth of Bitcoin on its balance sheet. Its total debt is about $8.2 billion. And its annual interest expense plus the dividends on its perpetual preferred stock is about $780 million. And so you just do the math, and Bitcoin would have to plunge precipitously from its current levels for strategy to even be in the realm of what would be described as trouble. And as we have calculated it, just to get to the point that the company would no longer be in a position to cover its convertible debt. Again, that's $8.2 billion.
Right.
The price of Bitcoin would have to fall below $12,700 from where it currently has been around $90,000. So yes, we have seen some big drawdowns in Bitcoin historically, but I think there's a tremendous amount of cushion here the market is not taking into account.
Well, Mark, I do wonder, why you would recommend buying this equity when if you're a common shareholder in Strategy, you're likely going to be diluted. You think about how they raised that dollar reserve. They had to issue stock to do that. And to borrow, some lines from the Financial Times, for every new share issue, that's going to dilute the stake of the common shareholders, while more of that money goes to covering obligations to the preferred shareholders. So, for folks following your recommendation and buying in, there's a chance here they're just going to get diluted.
Well, I think the element that's being missed there is the leverage that's inherent in Strategy's business model. Yes, the company did issue stock under its ATM facility so it could create a U.S. dollar reserve specifically to address concerns about where the cash would come from to cover the interest and dividend payments, which we believed was prudent. Now the company has 21 months of cash in reserve that will be specific to addressing those obligations. But going forward, what we are going to see is Strategy doing what it has done over the last number of years, issuing stock, issuing perpetual preferred stock in particular, which has no fixed maturity date and is effectively permanent capital for the company, and then turning around and adding to its Bitcoin. What that does is it creates leverage within the operating model, positive leverage, and amplifies the impact of the acquisitions that the company is making. And so what we are looking at in terms of metrics, one of the biggest ones is Bitcoin per share.
Right.
And we have seen the company increase its Bitcoin per share over time. That is increasing value to the shareholders who are investing in the stock specifically so that they can have a levered play on Bitcoin.
Right. Unfortunately, Mark, we're up against the clock here. Have to have you back on for a broader conversation. That is Mark Palmer. He is Senior Equity Research Analyst over at the Benchmark Company. Now, coming up, the rate of change due to AI in today's online information ecosystem, making it more pressing than ever to have verifiable sources of information. We're going to speak to Jimmy Wales. He is the Wikipedia co-founder. Next.
3:30 p.m. in a wet and wild New York City. This is the countdown to the close. I'm Romaine Bostic.
And I'm Katie Greifeld. Certainly looks disgusting.
Don't go outside, Katie Greifeld.
Yeah, don't fly anywhere.
It took me an hour just to go like about 20 blocks.
Yeah, I haven't left the building in a long time.
I would not leave the building tonight.
No.
Yeah, just stay here. Anyway, we want to talk real seriousness here as we count you down to the closing bell and take a little bit more holistic look at what's been going on around the world, particularly when it comes to AI. There's a recent report out there by KPMG that finds that trust in AI remains low. Only 41% of people in the U.S. are willing to trust it. So how does that impact how we search for trustworthy information, particularly at a time when the first results, when you, of course, go online, are AI-generated findings? Let's bring in Jimmy Wales. He's the author of The 7 Rules of Trust, a blueprint for building things that last, a new book that is out. And of course, you probably know him for being the co-founder of Wikipedia. Jimmy, great to have you here.
Great, thanks for having me on.
An intriguing book. Believe it or not, I actually read it cover to cover because I am one of these people that is a little wary about what our future holds. And when I think about what you created at Wikipedia, it wasn't just a repository of information, but it was a repository of trustworthy, or at least the perception of it being trustworthy. And we're now in an era where everyone seems to disbelieve their own lying eyes for whatever reason, whether it's the distortion from AI or even before that, the idea of political discourse that has sort of bent the truth. So where does a place like Wikipedia, where does a place like Jimmy Wales even fit into our future?
Yeah, I mean, I think people still are very, very interested in finding quality information, sources of information that they can trust. I actually hope that some of the things that have happened with AI have helped people to understand that we need journalism, we need quality information, we need to get it right. And of course, AI, one of the reasons people don't trust it is not that they've lost trust in everything necessarily, but because it actually isn't trustworthy. We've all seen AI make mistakes and errors, and sometimes quite hilarious, and sometimes not so funny. And so, I'm optimistic. I do think people are really passionate about wanting the truth.
You do. What about the idea of collaboration? I mean, Wikipedia was kind of one of the ultimate sort of examples of collaboration. Complete strangers. People didn't know each other, finding a way to work together. And now we're in a society where it seems like no one trusts anybody unless they're, part of your tribe.
Well, I mean, it seems that way sometimes, but I actually caution that if we're not careful and we spend a little too much time on Twitter or whatever like that, you can get a very negative view of human nature. But we have to understand the algorithms are promoting content that's divisive, or even if the algorithms don't do it, people are drawn, like moths to a big argument or a fight or a flame war or something like that. But actually, if you think about normal day-to-day life and people you meet, you still pretty much trust people. Most people are basically decent and good. And online, there are still wonderful places. There's still horrible places. All of these things are true at the same time. But I do think people can come together. They can have thoughtful conversations. They can, move the needle on their lives and on trust.
And I hear what you're saying, that social media is not real life. It is a refreshing perspective that, you go out and meet people, you're going to have a different experience than if you spend all day on X, for example. I do want to talk about Wikipedia and how Wikipedia fits into a world where more and more people are using chatbots. It's become sort of, a second muscle that people are developing that muscle memory with. So, do you have any existential concerns that, if people get so used to using ChatGPT that maybe they'll just skip the step of going to Wikipedia?
We do think about it. Obviously, you have to think about, as there's changes in the technology, change in the media landscape. It's something we've been thinking about for years, though. For example, the move from largely desktop to largely mobile page views meant a lot of things about how do you edit Wikipedia from a mobile phone. It's quite hard, and so on and so forth. So we have to be aware of that. We're not super concerned, simply because, well, for one thing, we're a charity and we're volunteers, and we just edit Wikipedia because we love it, and we're happy that it's popular, and that's great. But it isn't why we do it. We do it because we care about knowledge. We care about, getting in the weeds and some details on some geeky topic that we really care about. But I do worry, for the world. If people are not aware of how flawed large language models are, and they take what it says. One of the biggest problems with large language models is, even when they're wrong, the way the technology works, kind of guessing the most plausible next token, next word, generates things that are wrong but plausible. And that's actually, in a way, worse. If you asked a question and it said something completely crazy, you would go, oh, that sounds crazy. But if it sounds plausible, you might believe it. And so people need to be aware of that. They need to believe, you really can't trust it.
And I love that point that, you built up Wikipedia and, your folks continue to edit Wikipedia, including all the volunteers, because you love it. There's something so pure about the fact that, you're just pursuing information. And Wikipedia has seen so many different cycles when it comes to the internet. You think about just how many decades Wikipedia has existed. This moment in time that we're talking about when it comes to AI, when we're talking about the internet and talking about trust, can you compare this period to any other when you think about Wikipedia's history?
Yes and no. There's always something new, and there's always some threat to Wikipedia and so forth. But also, I think people do forget. We can have a little bit of a rosy view of what the early days of the internet was like. But the truth is, there were massive flame wars and angry people and all of that. All of that's always been with us, sort of random crackpots putting forward their views and so forth. But, I do think, the changes in technology are really important. And we do have to focus on it. But, what we're really focused on is that question of trust. How do we make sure that our community is healthy, that we're happy, that we're working really hard for quality, we're relying on quality sourcing? Because as long as we do that, we'll have a place in the world.
How do you police that, though? Because, it's one thing, you have to obviously vet, what the sourcing is, whether it's reliable. But then there's also the issue of not wanting to tamp down someone else's free speech or their opinions, even if those opinions may seem flawed, if you know what I mean.
Yeah, we have a few techniques. Part of it is, and this is rule number 3 from the book, is have a central purpose. So the purpose of Wikipedia is to write a free, neutral, high-quality encyclopedia, and that gives a lot of clarity to decisions we make. So, if you say, oh, well, how do you adjudicate between the New England Journal of Medicine and a social media influencer? We say, well, it's an encyclopedia. So we want quality sources, so we want that. And it turns out, actually there's loads and loads of people who are actually quite nice and calm. And so we try to just tune out all the noise of the world and just have constructive dialogues, constructive debates in the community.
Yeah.
It's never easy, but it's just what we do.
You reference the idea that you are a charity, a nonprofit. I mean, how secure is Wikipedia's future with that?
I mean, we're okay. I mean, we always have to take fundraising very seriously, and the vast majority of money that supports Wikipedia is the small donors. Average donation is just over $10. And that's really important for our intellectual independence. We're coming up on our 25th birthday, and we've been doing it for a long time. So we're confident the public will continue to support us. Our donors are happy and all of that. But you do have to worry. Certainly one of the things that we're kind of raising our hand to complain about is all of the AI bots scraping Wikipedia are actually costing us a lot of money, and our donors aren't donating to subsidize Sam Altman, they're donating to help Wikipedia. And so we think they should be using our enterprise product and sort of...
Has there been any discussion about suing or any kind of legal action?
No, not yet. Not yet. I mean, we're too friendly and
too friendly. Yeah.
But we, Google's always been a great customer of the enterprise product, and we're talking to the others. And we may go in for whether or not we would use Cloudflare or not. I don't know. I'm not on top of all that stuff. But using something to block the AI crawler bots to say, look, it's really not fair. Like, you need to pay because you're costing our donors a lot of money, and that's not really what it's all about. That's something that we would probably consider.
All right, Jimmy, so enjoyed this conversation. Really lovely to spend some time with you. That is Jimmy Wales. He is the co-founder of Wikipedia, also the author of The 7 Rules of Trust, a blueprint for building things that last. Now, coming up on the close, Signet shares losing luster despite a shiny earnings beat. We'll unbox the move in today's Stock of the Hour. Up next, this is The Close on Bloomberg. Our Stock of the Hour is Signet Jewelers, the CEO telling Bloomberg that management is, quote, conservative on the quarter ahead because, quote, we know the consumer has a lot going on. Those comments coming despite beating Wall Street's third quarter estimates this morning. Joining us now is Bloomberg's markets correspondent, Norah, Mulinda. So not exactly cheerful comments coming from the CEO, especially ahead of the holiday season.
No, I love that comment. We know that the consumer has a lot going on.
Busy,
As I call it, balling on a budget. That's what we're seeing right now from a lot of consumers. And of course, as we think about the consumer more broadly right now, all the way that we did see these metrics that came in and they beat expectations for the company, they're essentially saying, hey, let's play it safe. We don't really know where the consumer is going to be spending their money right now, especially as we think about a lot of these diamonds, jewelry being a discretionary item.
Okay, well, not for everybody.
Some people need a ring,
For
right?
some stuff, that's a consumer staple. But it does get to the idea, too, because we've talked to the Signet CEO a couple times, and they talk about this idea, too, how jewelry buying had shifted. It wasn't just about, me gifting to a significant other. It was about me buying for myself or someone else buying gifts for themselves. And I guess, is that the issue? Is that the people who were basically indulging in this as a treat to themselves, basically, that don't have the money or basically have decided to save their money?
Well, people are being a lot more thoughtful with where they're spending their money. As we think about this holiday season into Valentine's Day, this is the period that you tend to see an uptick.
You're already talking about Valentine's Day?
That's what people are talking about on the street.
It was Thanksgiving last week. We haven't even gotten to Christmas.
And now we're already thinking about pink
hearts,
hearts, right?
Don't forget Kwanzaa, which nobody cares about.
No.
I think Hanukkah's in there somewhere.
We're skipping ahead,
then you
right?
got New Year's.
Markets are forward-looking and
we got a lot of holidays, isn't it?
I know. It's wonderful. I love it. But talk to us, though. What were you saying about Valentine's Day? It sounded important.
Yes, so there's a lot of urgency right now when they're thinking about the time period between the holiday season into Valentine's Day. This is when a lot of people tend to do engagements. And so that's what they're really looking at this season to see who's really going out there. We talked before about lab-grown diamonds versus the raw materials, and you're certainly still seeing a lot of people going for a flight toward lab-grown because it's much more affordable. You're seeing, what, a 60 to 85%
and that's
discount.
hurting Signet, though?
100%.
But can't they not pivot there, or do people buy like just gold?
No, they definitely.
Silver?
That is a large portion of their portfolio.
Yeah.
It is actually a lot of the lab-grown diamonds. But as you think about diamonds more broadly, that's also a part of the market that we've been keeping an eye on. As you look at Pandora, you look at a lot of these other companies that are pressured right now. It's about the fact that people are going toward the lab-grown materials as opposed to the raw materials here. But of course, like Signet does have that sector of the market as well. So something to think about.
All right, are you lab grown or you're natural, raw?
I'm natural.
I've been asked this question so many times today. Natural, ideally.
Yeah, ideally.
But I heard that they look the same.
Yeah, chemically, you can't tell them apart. That's what I hear.
Well, nevertheless, Cigna shares down about 6% here on the day. One of the biggest decliners on the day here. We're going to take a look at the broader market when we come back after the break. And to count you down to the closing bells here on this Tuesday afternoon, Jerome Schneider going to be joining the big program. Stick with us. This is The Close on Bloomberg.
Specifically within the equity market, I would say it's all about tech, and where tech goes, the broader market goes. So you've seen, obviously in the sell-off, a huge bid to the volatility of the tech sector, QQQ volatility trading at a one-year high relative to SPX. That's starting to normalize a little bit, but it's still very elevated. So I think that's going to be a point of focus within the equity market.
Mandy over at CBOE kicking us off to the close just about 50 minutes ago. A look at volatility. Well, of course, overall, it has been a little bit elevated, though today, tamped down just a bit as we see the broader market try to get its sea legs back.
Absolutely. Looking at a little bit of a rally here on the S&P 500. I'll note that trading volume, still pretty light, down about 14% compared to the 30-day. Right? I know, well, it's raining in New York. Maybe that's a factor. But maybe we're also in a holding pattern ahead of that Fed decision. That's something we talked about with Mandy, because even though the market has swung to expecting a rate cut from the Fed, this still feels to some extent like a live meeting. Yeah, absolutely. And we should point out, too, I mean, it's like this idea that so much of what we're seeing in the market right now seems to be tied to next Wednesday, and the idea that people are waiting for that clarity. A great story today, I should point out, on the Bloomberg terminal, showing just how divisive right now that debate amongst the FOMC members are, at least based on their public comments. And that's the context for what they're going to have to talk about behind closed doors on Tuesday and Wednesday. All right, well, our next guest says that when you take a look at equity markets and the relatively rich valuations there, income-based allocations actually may prove a bit more flexible and less susceptible to some of that market volatility, which of course may emerge even further depending on what the Fed does next. Jerome Schneider joins us right now at Pimco, Managing Director, Head of Short-Term Portfolio Management and Funding. All right, Jerome, let's start there here with the income-based allegations, particularly against the backdrop of this Fed meeting next week.
Yeah, it's a confluence of events, and we would urge investors simply not overlook the last few weeks of 2025. You have three main implications to think about. Number one, continue to focus on the FOMC. Perhaps this meeting is live in more regards than just simply a rate cut. It's live in the sense of the messaging as you get into 2026, and really what the FOMC is going to be focused on, that balance between labor and that balance between inflationary numbers that are pushing up against that 3% core is incredibly important. The second thing to pay attention to is liquidity conditions. And what we've seen over the past few weeks is a focus on the micro of liquidity conditions, fluctuations in repo rates, funding rates, et cetera, sort of piquing people's interest. We're not necessarily concerned about any systemic risks there here at Pimco, but more broadly speaking, as you've seen excess reserves decline in the overall economy, that means there's simply less cash chasing investments and risk assets at that point in time. And it's something to think about in terms of those asset allocations in the longer term. And the final thing is the economic outlook. This is clearly a K-shaped economy. And the last month is going to begin to have people emerge from their morass, that dearth of data, economic data that we've had over the past few months. We're going to begin to see inclinations of that. And perhaps that data will shed some light on where the economy lies. Where we stand today at Pimco, we believe that it's a bifurcated economy. One where you have growth areas clearly delineated by AI and productivity there, and a labor market which is under pressure at points in time. That's going to perhaps be the focus of the FOMC over at the next meeting.
Well, speaking of the FOMC, there's another issue here, Jerome, and that's exactly how the FOMC changes over, in theory, the next 6 to 7 months, with the idea that we are going to have a new Fed chair in place by the June meeting of next year, one way or another. I want you to take a listen. The President of the United States addressing some of the speculation about who he may pick. He was just speaking earlier today. Take a listen.
I guess a potential Fed chair is here, too. I don't know. Are we allowed to say that? Potential. He's a respected person, that I can tell you. Thank you, Kevin.
And kind of hard to discern amongst some of his mumbling, but of course he's referring to Kevin Hassett, the former National Economic Council member. Is there a sense here, Jerome, that a Kevin Hassett Fed would be any materially different than a Jay Powell Fed?
Yeah, well, clearly there's going to be a bias toward that dovish sentiment, given sort of he's made it this far and basically succeeded in the trial balloons that have been floated. Markets digesting it actually pretty well of note as well. Perhaps in the confirmation process, there's a few people who begin to be concerned about the politicalization of the Fed and simply that he's becoming from the establishment on that side. But in general, we think that there's still credibility, still people who are going to lean toward into that Fed independence and appreciate that Fed independence. So longer term, there really isn't a great concern for the market to behold. Yes, that dovish bias might perhaps be one view represented at that table, but we've also seen, even in the Jay Powell era and more recently in that era, we're going to see that committee work to this point, meaning digest the data, have an output which is collegial and perhaps bifurcated in the end with some footnotes, but getting to the consensus which is appropriate, taking into account the two mission statements being full employment as well as the inflation metrics. And we think that perhaps becomes a little bit more clouded from a practical perspective as we get into 2026, but from an implication of Fed independence, we're not necessarily so inclined to have great worries at this point in time.
I hear what you're saying, but even still, it seems like the consensus is that we're going to see a dovish Fed next year. We're going to see a central bank that's going to be lowering interest rates. TBD, of course, what the magnitude of that looks like. But given that, you can probably bet with some certainty here that we're going to get lower rates, how does one position a portfolio around that? And I'll point out a headline coming from Crane today that money market assets, for example, rose to $8 trillion for the first time, Jerome.
Two things to think about in this context. Number one, risk assets have been buoyed by the expectation of Fed rate cuts over the foreseeable future. Perhaps the market's forecasting as many as 4 rate cuts over the next year. If it happens, and it's supporting animal spirits on those risk assets pretty substantively. If those don't come to fruition over the course of the next year, perhaps that creates some deflation in terms of risk asset pricing, leading to market volatility, et cetera. That's where the entrance of fixed income comes in, and really the derivation of fixed income. We believe that not only are we having attractive nominal yields here, but real yields, inflation-adjusted yields, help protect investors from that broader market volatility which could emerge next year. So the starting point of things like risk assets, credit spreads, yes, those are perhaps a concern in the immediate focus. But when you take a broader step back, ways to derive total return are really fixed income based. Now, back to the point about money market funds, $8 trillion is a substantive amount. What we're finding ourselves is people who are becoming defensive. That defensive momentum is picking up. And we're finding them go to money market funds. Those savers were once shadow savers, they're now real savers. And we have to encourage them to take a step out of that saving in the traditional sense, out of T-bills, out of money market funds, into something more active out the curve, more active in terms of diversification of the portfolio that allows them to outperform not only Fed funds, but earn an additional return of 1%, maybe 1.5% above money market returns by being in that ultra short type of mutual fund space. That being said, we think that there's a reason to be a little more cautious at this point in time, given those clouded outlooks and where the market is pricing the longer-term expectation of rate cuts.
Always great analysis, Jerome. Always great to talk to you. One of the best in the business, Jerome Schneider, head of short-term portfolio management and funding at Pimco, helping us count you down to those closing bells. But our coverage is just getting started. Another busy day on Wall Street. A full breakdown begins with our global simulcast.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Katie Greifeld taking you through to that closing bell with the global simulcast. It started. There's Carol Massar. There's Tim Stenovic in the radio booth. Welcome to our audiences across all of our Bloomberg platforms, including our partnership with YouTube. We had, I guess, Carol Massar, what could be described as a bit of a rally in our hands, so we're seeing it fade just a touch into the closing bell.
Yeah, it's kind of like, you just look at the charts throughout the day. It's like up, down, up, down, up, down. Definitely finishing, it looks like. Oh, so I've heard. Hey, but the S&P 500, I mean, I don't know. I guess it's interesting. I just think everybody's thinking about next week, what do we get from the Fed? I know I keep saying that, but I really do think that's what the trade's about.
What do you think we're going to get?
I mean, it looks like we're going to get a rate cut, but I think it's more about what we get in 2026. What kind of, forward-looking policy information we get?
I'm focused on the here and now when it comes to Bitcoin. After yesterday's rout, up 5.4%, 91,115, Katie, for Bitcoin. I know you are now, because You co-anchored Bloomberg Crypto with me.
I did.
A crypto lover and expert after that experience.
Yeah, we had a great conversation with the CEO of Strategy. And Tim, I'll remind you, we anchored a crypto show together a few years ago, but that was in a totally different crypto environment. I don't have a good reason.
That was in real life, too.
That was in IRL, you could say. I don't have a good reason.
So you spoke a little bit earlier to Michael Saylor?
No, we spoke to Fong Li because Michael Saylor, as we've been reminded, is not the CEO of Strategy.
He's the chairman and co-founder.
The co-founder, the chairman, as you say, but currently not the CEO.
I always forget that. I gotta watch that interview.
Yeah.
All right, we get the closing bells here in New York, and an update for some of the major indices. The benchmark S&P 500 is going to add about 17 points on the day, or roughly about a quarter of a percentage point. The Dow Jones Industrial Average up 180 plus points, or 0.4%. The NASDAQ indices each up, well, the NASDAQ composite, I should say, up about 0.6%. The NASDAQ 100 up about 0.8% here on the day. And we should point out that we saw the Philadelphia Semiconductor Index move higher by about almost 2% on the day. But you take a look at the Russell 2000, as well as the S&P 400 mid-caps, both down in the red on the day.
Yeah, semi-name among my outperformers, one of my gainers. We'll get to that in just a moment. Back to the S&P 500, and we've got 216 names gaining ground on this Tuesday. Katie, 286 to the downside, one unchanged.
All right, let's take a look at the circle. Not too much in terms of green. You can see that information technology, given that it has such a big weight, rising about 0.8%, but overall only 3 sectors finishing in the green. You had 8 in the red. In terms of what didn't do too well today, you had energy, materials, utilities, healthcare leading losses. So not a lot of breadth behind this rally.
Did you ever see that reality show called The Circle?
I haven't, actually. I keep thinking of the stablecoin.
Yeah, it's not about the S&P 500.
What's it about?
It's fighting, love.
Oh.
You know, what most reality
Story of my career.
Yeah.
All right, let's get to some of the individual gainers. Boeing, number one gainer in the S&P 500, everybody.
Yeah, how about that?
I know, like for something different, up 10% and pretty much closing at its best levels of the session. The company planning to or expects to generate cash again next year, 2026, with positive free cash flow to reach the low single digits next year. Company still expects to eventually reach the $10 billion cash generation target outlined by the previous management team. This is according to the CFO. Keep in mind, here's the back story. The free cash flow at Boeing hasn't been positive on an annual basis since 2023, and the company faces $8 billion in debt payments next year. So, yeah, that's the balance sheet. Intel, yeah, also an outperformance. You mentioned the stocks earlier, Romaine. Intel, your number 2 gainer in the S&P 500, number 1 gainer in the NASDAQ 100, a gain of 8.6% here at the close. Continuing really a rally that we've seen that's pushed this stock up more than 100% year to date, up to its highest intraday since April of 2024, and the stock is up 121% in the past 4 months alone. So it's been on a move to the upside. Intel shares recently moving higher on talk, rumors, and analysts noting a potential deal with Apple to outsource production of its entry-level M-series chips. That analyst is TFN International Securities Analyst. So apparently making a post on X that he expects this deal with Apple, but nothing confirmed. So I'm being careful about this one. But investors pouring into Intel. Lastly, I just want to get to Shopify, up about 5% in today's session. Top gainer in the NASDAQ 100. This is after its merchants achieved record sales of $14.6 billion during the Black Friday, Cyber Monday weekend, representing a 27% increase from last year. So some good news there. We're out there shopping. Yeah, that's it.
Okay. Those are the gainers. I got the decliners. The worst performer in the S&P 500 today was the company formerly known as Square. It's now Block, down 6.6%. The company flagged weakness in gross payment volume for its Square segment in the fourth quarter compared to the 3 months earlier. This during a presentation at the UBS Global Technology and AI Conference. On the Square side, we continue to expect GPV growth in the low to double-digit range, said Block's Owen Jennings. So a slight deceleration relative to Q3, largely driven by some weather events in October. Once again, shares of Block today down 6.6%. And then American Bitcoin. This is the Bitcoin miner / hoarder, co-founded by Eric Trump. This fell as much as 51% earlier in the session. Trading was halted a couple times. Shares fell by the end of the day down 39%. This after restricted shares of the company were freed up to be traded. Shares from a private placement that took place before American Bitcoin merged with Griffin Digital Mining became available on Tuesday. This according to the crypto miner in a post on the social media platform X by Eric Trump, rather. Once again, shares of American Bitcoin down 39% today. And finally, Signet Jewelers shares slid by 6.8%. This is the parent company of Kay, Zales, Jared, and many more. Worst day going back to April. Signet's fourth quarter same-store sales forecast fell short of the consensus estimate. The company expressed a note of caution on the consumer. The company's CEO said the, quote, measured fourth quarter outlook on external disruption since late October and potential continued softness in consumer confidence. Interestingly enough, Black Friday, not a major sales event for most of Signet's brands. They tend to sell closer to Christmas because engagements pick up during the holiday season and through Valentine's Day. Wedding-related jewelry typically makes up more than half of Signet's sales.
All right, a quick check on yields here, a mixed day, and we talk about this idea of what the Fed does next in the market, despite what some of the Fed funds futures suggest with regards to options pricing, not necessarily reflected in treasuries. You did see short-term treasuries move lower, down about 2 basis points, long-term treasuries slightly higher here on the day, but overall, this is a bit of stasis as folks await what comes next. What's next?
All right, folks, just want to get to some earnings crossing the Bloomberg terminal. GitLab just down about 0.8% as it crosses the Bloomberg terminal. That stock is off about 23% year to date, so building on some of those losses in the aftermarket. Third quarter adjusted EPS, 25 cents a share. That's a nickel better than what the street was forecasting. Third quarter revenue coming in better than forecast, 244.4 million versus an estimate of 239.5. But here's the outlook. Sees fourth quarter revenue, 251 million to 252 million. The street estimate is kind of right there, 251.9 million. And then the company sees fiscal year revenue 946 million to 947 million. It had seen 936 to 942 million. So not quite sure why the street is seeing so much disappointment. Stock down about 9% here in the aftermarket.
Let's talk about Marvell, of course, the chip technology company here. It looks like the headline actually is not the earnings here. The company is said to be buying Celestial AI, the company actually making that announcement officially in a statement right now. It doesn't appear that terms of the deal are included in this situation, but you're seeing the shares move lower by about 2% here in the after-hours trade.
Should we talk about lunch?
Yeah, you want to talk about those slop bowls?
Yeah.
Apparently, everybody's kind of over them. That, those bowls where you throw some rice and some other stuff and then you throw everything on top of it. Well, apparently, people are over it. Consumers want something different. They want something you can hold in your hand like a good old sandwich.
Yeah, Steve Ells, the co-founder of Chipotle and the burrito bowl that rocketed the chain to lunchtime fame, has moved on. At a Manhattan location of his new concept counter service, there's a red neon sign. It depicts a lunch bowl with a slash through it. It's a bowl-free zone, guys. They say they love sandwiches and anything as long as it can go on bread. So long live the slot bowl, or is it the end of an era?
Well, first I'd just like to point out, counter service, I love this place, by the way. And I went there a few times before I even realized it was actually owned by the co-founder of Chipotle. But the problem with the bowls is they just became so prolific, right? I mean, everyone does this. I mean, it was unique at one point, but now it's like, every, bodega on the corner here is doing a slot bowl.
Well, it's interesting to see how that's being expressed in the stock market as well, because you think about Sweetgreen, you think about Kava, they're both down year to date. But you compare that to 2024. I mean, these were the all-stars in the stock market, up triple digits. And it's interesting just how quickly the winds have changed on specifically these two.
Do you think pricing had an issue?
I have to imagine. I mean, you're paying $20 for a sad salad with not that much protein on it. That's how I feel.
You could get the new ultra high protein Sweetgreen one that they offer.
Oh, right. Isn't it 100 grams of protein?
Yeah.
What do? They put like a foam on top or something? Like
it's a lot of chicken. I think 3 scoops of chicken, some broccoli, and
some crushed up crickets, perhaps.
Tahini dressing also. I don't think the crickets are included.
Yeah, I don't know.
Yeah, but it gets to this idea of like why trends change, like whether it's economic or whether it's just social and cultural. We've had our fill of bowls and now we're on the sandwiches.
Listen,
maybe.
I always loved a
sandwich.
sandwich.
And why sandwiches? You said handheld. Why not like, I don't know, a patty, empanada, a hoagie?
That works too.
A grinder.
I hope someone's listening.
A sub.
Yeah. Are you giving people ideas?
Pierogi.
Is that handheld though?
Yeah. Oh, yeah. You can handhold anything.
Grab it with your paws.
You can handhold anything.
Truly.
I like the initiative there.
How about a cocktail? That's handheld. Okay.
Yeah, bring those back.
Yeah. All right. That's a wrap. Our cross-platform radio, TV, YouTube, Bloomberg Originals. We call it The Closing Bell. Katie and Romaine continuing there on The Close on Bloomberg TV. Tim and I continuing on Bloomberg Business Week Daily. We will see you again, same time, same place tomorrow.
And our coverage continues here on Bloomberg Television. A slew of earnings crossing the wire right now from companies like Pure Storage, Asana, and others, also awaiting earnings out of CrowdStrike. We're going to break that all down when we come back after the break. This is The Close on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Katie Greifeld.
And I'm Romaine Bostic. A broad market that tried to get its mojo back. It did not claw back all of the losses from yesterday, but certainly a modest shift in sentiment, a 1/4 percentage point gain for the S&P 500, largely led by big tech, the Magnificent Seven adding about 0.5% on the day, but you're still seeing a bit of defensiveness in the market, a modest bid into short-term treasuries, a stronger bid into silver at another record high on this day. And, well, some risk appetite is also back, at least reflected in Bitcoin, bouncing off its recent lows back up above 91,000.
Meanwhile, let's take a look at some of the after-hours movers right now. We are getting earnings out from American Eagle. You can see shares are soaring right now. Third quarter net revenue beat expectations. Marvel is an interesting one. Of course, they did report earnings, but it seems like the stock is moving more on this news that they're going to buy Celestial AI for at least $3.25 billion in cash and stock. You can see shares down about 6%, even though their third quarter adjusted EPS did come in above estimates. Meanwhile, CrowdStrike, too, we want to focus in on getting earnings for that company as well. Their fourth quarter revenue coming in $1.29 billion. That's the expectations, $1.29 billion to $1.3 billion. The estimate was for $1.29 billion, Romaine. So a little bit higher, that range, than the expectations.
Absolutely. Here, the shares kind of pinned right now around the 1% range. Peter Levine joins us right now, equity analyst over at EverCore, who covers CrowdStrike and I believe has a neutral or inline rating on the stock. Peter, I know, what's your knee-jerk reaction so far to the numbers that we just got?
Yeah, the numbers just came out, so stock's slightly flat to up. I mean, it looks like numbers for the quarter Q3 were strong. You didn't really see that much upside on the revenue. I would say the metric a lot of investors focus on is net new ARR. That came in above, I think, what investors were expecting. So I think it was more of an inline quarter than I think the magnitude beat I think some were hopefully expecting, especially at this value rate.
Well, with regards to that metric, I mean, we're talking about on a year-over-year basis, a 73% jump in that net new annual recurring revenue, and that's also above estimates. I mean, analysts were expecting about a 60+% gain anyway. But I am curious about what led to that 70% jump, and what are your expectations for the quarters going forward as to what that growth rate can be?
Yeah, sure. So I think within that number, don't forget, this is the first year we're comping over the outage that CrowdStrike had last July. So this is the quarter. So it was a negative. I think it was like a negative 25 or a negative 30% number. So a much easier comp here in the second half. So they are, I would say, it's an easier comp versus the issues with the outage that occurred last year.
Well, with Peter, with that in mind, given that it was a fairly easy comp when you think about what they were dealing with that outage, the fact that they didn't blow it out of the park when it comes to these figures, you take a look at that tepid gain in the after hours. Could you see the sentiment actually souring by the time we get to tomorrow's open?
I mean, it depends on what they say in the call. I think a lot of the commentary is going to be around anything with Q4, ARR. They don't guide to it, but any indication in terms of where that's trending. It's also a lot about the platform consolidation. We've seen that across all of cybersecurity, Palo Alto, Zscaler. Like the consolidation is happening, and CrowdStrike plays into that. So I think investors are going to want to understand the identity, next-gen SIEM, cloud security, data security, what they're doing with AI. So traction around a lot of the growth levers that they're having. So a lot of it depends on the commentary. Looking at the full year guide, again, not that much of a raise based on, I think, what some were expecting, but a little bit muted in terms of, I think, the upside getting carried forward.
Well, when it comes to platform consolidation, that was one of the reasons why Wedbush came out pretty vocally that they view CrowdStrike as really a growth story here. When it comes to specifically that point, platform consolidation, what are you hoping to hear on the call later on today?
Yeah, you want to hear about module adoption at renewal, especially for customers that were impacted from the outage. So a lot of this kind of stems from that CCP package, which was kind of their kind of package to customers that were impacted. So you kind of want to see customers actually adopting and paying for a lot of the modules that perhaps they got for freer credits. So a lot of it's around just module adoption at renewal, net new customers coming in and adopting 1, 2, 3, 4 products. So it's really more about customers expanding and using more of CrowdStrike. And a lot that goes with Falcon Flex and their consumption model. And again, that makes it easier for customers to adopt more. But if you think about the growth, again, you're looking at call it a 21, 22% growth story, which is impressive at that run rate. But I would say valuation here, from our perspective, would seem, I think, baking in a lot of, the bullish or optimistic upside.
Hey, Peter, before we let you out, I do want to get your thoughts on Okta, which also just reported here. More importantly, I mean, they beat in the current quarter and the most recent quarter, but the forecast they gave here, a slight nudge up with regards to their EPS and revenue forecast. How does Okta stack up against the rest of the companies in your coverage in this space?
Yeah, sure. It looks like the stock is down about 2.5%. Okta plays in the identity space, and they've been plagued with some execution issues historically, but they've but again, I would say the last couple of quarters they've executed fairly. I think what we don't know is the initial guide for next year, which is a big number they give in Q3. So investors will be focused on what growth will look like next year. For Okta in the identity space, AI is important, and every AI workflow, every AI agent needs to have an identity attached to that. And I think Okta's done a really good job of broadening out and building out the platform outside of the core with governance and privileged access. You've seen those products mature, doing a much better job bundling, pricing those offerings. So again, I think from the Okta call, you kind of want to hear more about the platform adoption, their place on an AI and the monetization of that.
All right, Peter, really appreciate your instant analysis. That is Peter Levine. He is equity analyst over at EverCore. Romaine.
Some breaking news here on Nike. CEO Elliott Hill, who took over about a year ago in 2024, continues to make more management changes, including establishing the role of Chief Operating Officer. Venki Alagrasamy is going to be taking that role. He's currently the Chief Supply Chain Officer and will assume that role starting, I believe, next week as COO. There's quite a few other changes in here, including the elimination of the Chief Technology Officer position. The person holding that will leave the company, and a slew of other changes with regards to who will be reporting directly to Elliott Hill. The breakdown is largely based on geography. They're also saying that they're going to eliminate the role, Katie, of Chief Commercial Officer, a role that Craig Williams has held for some time. He'll be moving on.
Yeah, really interesting news coming out of Nike. We will continue to follow that story. But coming up on the close, we're going to talk about last-minute holiday getaways with Hopper's lead economist, Hayley Berg. She joins us next. This is The Close. Well, move over Black Friday and Cyber Monday because Travel Tuesday is here. The annual shopping event is traditionally the biggest day for trip discounts during the holiday sales week, according to travel company Hopper. Joining us to discuss is Hayley Berg. She is Hopper's lead economist. So Travel Deal Tuesday was something that was coined by Hopper back in 2017. How much activity do you typically see on the Tuesday following Thanksgiving?
Travel Deal Tuesday is by far the biggest single travel shopping day of the year. This year, we've brought together hundreds of travel partners who are offering special deals and discounts, and we're expecting to see what we've seen in previous years, which is 3 to 4 times more travel bookings made on this day than on Cyber Monday and Black Friday combined. So it's a big day for travel booking.
How good are the deals, actually? Romaine and I were just talking about this in the break, that, you think about some of the Black Friday, the Cyber Monday deals, that it doesn't feel necessarily like you are getting a bargain, that maybe those big discounts that you're getting are just a function of raised prices heading into the period. Hayley, I wonder what we see when it comes to Travel Deal Tuesday.
This year, we are seeing very strong deals both on airfare and hotel stays. Hotels, for example, we're seeing up to 40% off stays in places like St. Martin, Puerto Rico, cold weather destinations like Vancouver, Lake Tahoe. When you think about the cost of a hotel room night and a typical 3 to 4 night vacation or a weekend away, up to 40% is pretty significant savings. And we're seeing that on the Hopper app, on TripAdvisor, a lot of channels offering discounts this high.
I want to pick your sort of economist brain here, Hayley, because, I mean, there's been a lot of talk about the health of the consumer. And it's one thing to have the money to spend on something. It's one thing to say, okay, I might get 25, 30, 40% off. But it's another thing psychologically to say, okay, if we think that times are tough or maybe going to get tough, am I really going to be in a mood to book a vacation 3, 4, 5 months out, not really knowing what's up ahead? So what is that consumer psychology like right now?
Some of that psychology is how Travel Deal Tuesday came to be. Typically, the week after Thanksgiving is a low booking time for travel. You've got your holiday trips already booked. You're not thinking about 2026 yet. That's what has incentivized travel providers and brands historically to offer deep discounts during this week to try to drum up a little extra demand. I will say that even as we've seen households cutting back in some parts of discretionary spending, we've seen very strong signals that consumers are still protecting their travel and vacation expenditure as much as possible. Some of the ways they're doing that is by taking advantage of discounts when they are available on a day like this.
I've seen some anecdotal evidence, and actually some data for that matter, that seems to suggest that some people also are just eschewing long trips, meaning long distance trips. Driving somewhere instead of taking on the cost of flying, or staying with relatives instead of getting a hotel. Are you seeing any evidence of that?
We see a lot of different types of deal-seeking behavior, whether it's trading a long-haul trip for a longer domestic vacation, or mixing and matching, staying at a hotel or staying at a vacation rental. But American consumers are very savvy when it comes to travel. They're looking to, book with a credit card that offers points or loyalty to help lower the price, book on a day like Travel Deal Tuesday where they can get discounts, and take advantage of things like, for example, TripAdvisor offering $50 off experiences today, getting a little bit extra for their trip and taking some of the cash off the top with a special deal like that. That's how travelers are really getting to that end budget, even though their trips are still relatively robust.
And you mentioned destinations a little bit earlier, but I am curious how much, discounting impacts where people choose to travel, because a lot of folks have a destination in mind and then they search for deals around that. But are you seeing any evidence that folks see, okay, I can get 50% off here, that's where I want to go?
We definitely see more flexibility from travelers who are booking on a day like Travel Deal Tuesday. They come in thinking maybe warm weather destination or ski getaway, but aren't specifically tied to one destination. Those are the travelers who honestly end up getting the best deals. They are booking the highest discounts on hotels. They're booking the airlines offering the lowest prices on the day of. So there is definitely a lot of flexibility. But we also see about 45% of customers are still booking last-minute Christmas trips. Those tend to be less flexible. You're either going home for the holidays, or a lot of Americans repeat destinations for Christmas destinations.
Yeah.
So we see flexibility both ways.
Hayley, Berg, Hopper lead economist there. Katie Greifeld.
Yeah.
Are you taking advantage of Travel Deal Tuesday?
I kind of wish I was, because I am flying out to Utah tonight. The weather is not good, and it's expensive to fly, so I'm not in the best mood about it, but should be interesting to do some on-the-ground reporting. Yeah, well, good thing you're sitting in first class. What's your bucket list vacation? That's a good question. Probably all the places I've already been. I don't really like to try new things. That's not a bucket list. I'm an indoor bucket list cat. Is something you haven't done, Katie. Yeah, well, I would definitely
go to Antarctica, see the Aurora Borealis.
I would like to go back to Florida. I really like Colorado. New Jersey is great this time of year, so something to think about. What's your bucket list? You probably have a robust. I love New Jersey. You guys have the best toll roads. Yeah. All right. When we come back after the break, because I can't get Katie to reveal anything about what her bucket list would be, we're actually going to sit down and have a conversation with the CEO of Dell, Michael Dell. Of course, earlier today, the big news, a philanthropic gift to jumpstart what is, I guess, effectively supposed to be a government program. An interesting dynamic, and well, we're going to hear from the man himself when we come back after the break. This is The Close on Bloomberg. All right, one of the biggest news that we had this morning was learning that Michael and Susan Dell are making a $6.25 billion donation to jumpstart investment accounts for 25 million U.S. children. The act of philanthropy from the co-founder of Dell and his wife will apply to children 10 and under who aren't already eligible for government money, with Dell saying he expects to reach 80% of U.S. children in that age range. The move builds on the Invest America initiative out of the White House, which many know as the president's push to financially cushion young Americans. Joining us right now around the desk is Caroline Hyde. She is the co-host of Bloomberg Tech, and she brings us right now the CEO of Dell, Michael Dell.
A historic moment. Michael, welcome to Bloomberg. Compound interest, the eighth wonder of the world, some would say, and you're giving it with 250 million US kids each getting a jump start of $250. Why is this the right act of philanthropy for you?
Well, our foundation has been focused on children since the beginning. And when this Invest America Act was passed earlier this year, we saw it as a platform for companies and families and communities and philanthropists to contribute to these accounts. And as you probably know, the government is giving $1,000 to every newborn in an account that will essentially go in the S&P 500 and compound over time. And when the child's 18, it becomes like an IRA. It can be used for education, to start a business, to start a family, for continued savings, to buy a home. And so what Susan and I wanted to do was help out some of the kids that weren't included in the government program. And so the kids that are 10 and under that live in zip codes where the median income is $150,000 or less, that aren't in the government program, so think ages 2 to 10, we're going to give 25 million of those children $250 each in their account. And we hope that, this, inspires them and gives them hope and opportunity and prosperity. I've spoken with a number of other philanthropists. I believe you'll see some other significant gifts, and we know many companies are going to match the government's contribution, as Dell Technologies is certainly doing, and a number of companies have already announced. So we're super excited about what this can become over time as these accounts grow to be something significant.
Tell us about that. Tell us about how you are calling on companies like you to match what many are calling the Trump accounts, but also will those match what you're now doing for 2 to 10-year-olds, maybe 10-year-olds and above? Have you fielded many calls?
Well, we just announced this morning. I did speak with a number of philanthropists in the weeks leading up to our announcement. And, I won't speak for them. We'll let them make their own announcements. And they could be designed in a different way. I think you'll see some people adopting particular states or, particular communities. And in fact, we started with the idea of doing this only in the state of Texas, but then we decided to do it nationally. So there can be many varieties and alternatives here, but we do think that this will be catalytic, and that more philanthropists and companies will join us over time. And again, this is a platform for the future of these children.
Is it a platform for more giving from philanthropies or from billionaires such as yourself via government? It's extraordinary sort of turn of events that here you working directly with the Treasury, Michael. We've also seen Timothy Mellon at one point offering to help cover the costs of US troops during the government shutdown. Will more people be pushed and think it's right to work through the federal government?
Well, I would say we're not working through the federal government. we are giving $250 directly to 25 million children.
And this is being executed. I think we've just had a technology issue there. But Michael, this is being executed by the Treasury. When you think about how the process has been, you hope that it's, I understand, going to be seamless, process is going to be swift. How quickly do you think it'll be in the hands of those children? And indeed, will it be in alignment with the Trump accounts, so July of next year?
Yeah, so on July 4th, or I think 5th, actually, because the 4th is a holiday, of next year, every parent will be able to claim the account for their child that's 18 and under. And originally, those accounts will be held in custody by a custody bank, and then eventually you'll be able to choose your bank or your brokerage that holds the account for you, and it's the property of the child.
What banks, what asset managers have you been talking to? How do you think, from an infrastructure perspective, this would work, Michael?
Right. I have not been having the conversations with the banks. I actually, a number of them have told me that they're interested in being the banks to hold these accounts. I think it'll be, all the major banks, and, the parents will be able to choose whichever their favorite bank or, stock brokerage is.
What's so interesting is this has bipartisan support, as we understand, from letters being written just yesterday, asking Cory Booker as well as Ted Cruz, asking those to come alongside you for corporates to invest alongside.
That's right. I spoke with Senator Booker last night about this. I spoke with Senator Cruz about this earlier today. And there is completely bipartisan support for this idea. It's not a political initiative. This is about investing in children, and we think that's the smartest investment that we can make.
Michael, why do you think it wasn't picked up earlier than this? Since 2021, shout out to Brad Gerstner, is almost his idea, this initiative. Why did it take this administration this time?
Well, it's a great question. Brad did tell me about this in 2021. We talked to the prior administration about it. I think it's hard to get legislative action like this done, but now it's the law. And so here we are. And so we have a great opportunity for the future to build on this platform.
You really have been focused on education and on kids, Michael, in your philanthropic work. You're also a man very focused on the world of artificial intelligence. What's life going to be like for these kids going forward, do you think? How much will they be allocating their money? How much will they be allocating their time? What does a work week look like, do you think?
Well, it could be lots of debates about that. What I would say is that I would encourage kids and parents and educators to focus on the critical thinking skills and being able to analyze problems without the assistance of technology, but also use technology as a resource and as a tool. At the heart of this debate really is, as we get new and better tools, are we doing more work and solving more problems, and discovering new science and progressing further in the world, growing the economy? Or are we doing the same amount of work with just fewer people because we have the tools? You could put me down for economic growth and prosperity as a result of these tools. Certainly there will be challenges and dislocations, and retraining is certainly required. But from what I'm seeing, I think this is largely going to result in some really great outcomes. But again, it's not guaranteed success because of new technology.
That dislocation, Michael, whose responsibility is that? Is that big tech's responsibility to retrain, to reskill, to help at least pay for it? Is it government's responsibility, education?
I think it's a collective responsibility that we all have. I think every company has to reskill its workforce. I think the education system has to adapt and build the new skills and capabilities. And, there's a role for all of us to play in that.
And excuse me for this pivot, Michael, but of course, many want to understand, of course, the focus on infrastructure from a money perspective here to kids. There's also the focus on the fact that stocks have to go up and to the right in the longer term for this to benefit those children. What do you think about a concern about an AI bubble? Are this really reaping rewards from a productivity perspective, or are we in some sort of bubble or circular finance concern for you?
Certainly markets do fluctuate, and you know that well on Bloomberg because you report about it every single day. Long term, we think investing these accounts in the S&P 500 is a very good way to compound over time for these children. When I look at what's going on today in the enormous build out in AI, what I see is a lot more demand than supply for the ingredients. And certainly, in our business and many of the companies in this enormous build out, business is very good because there's enormous demand for what these models are creating, which effectively is intelligence. And if you now have a tool that causes everyone in your company to have 15 more IQ points in their daily work, well, that's something you probably want as much as you can get. And so there's enormous demand here. I think next year we'll be in a situation very likely where the demand exceeds the supply in many of the critical ingredients that go into the most advanced systems that we're building.
Well, you're certainly building something extraordinary on this Giving Tuesday. 25 million children, $250 each, $6.25 billion being philanthropically given by yourself and Susan Dell. We thank you so much, Michael Dell, for joining us today.
Thank you. Thank you. We think the smartest investment we can make is in our children.
All right, our thanks there to Michael Dell, of course, the CEO of Dell Technologies, Caroline Hyde, the co-host of Bloomberg Tech, as we continue our coverage here on The Close. A closer look, Katie Greifeld, right now at some of the after-hours movers.
Absolutely. Got a ton of earnings at the close. Let's take a quick look at some of them right now. Taking a look at shares of Okta. A sea of red right now. Okta shares down about 4%. Meanwhile, GitLab also in the hurt locker, down more than 8% right now. The fourth quarter sales forecast trailing at the midpoint. And also CrowdStrike, this is interesting. We were talking about it, that relative to pretty easy comps, CrowdStrike not exactly impressing.
Yeah, not impressing. And this has been the whole issue we talk about with some of these cybersecurity stocks, particularly ones that have dealt with breaches and other things. CrowdStrike trying to claw its way out of that. But like I said, you look at Okta, you look at some of their peers, not doing well either.
Yeah, it'll be interesting to see if the narrative changes at all as we get through these earnings calls and we get to tomorrow's open. But we do want to pivot a little bit here and talk about affordability. It was a key issue for voters in last month's pivotal elections. Now, one major catalyst is that strained housing market, under pressure in a big way from slowing price growth and competition to attract buyers. Joining us now to shed light on those dynamics in this part of the market is Shaun Donovan. He is the CEO and president of Enterprise Community Partners and former Housing and Urban Development Secretary under President Obama. Fantastic to have you with us.
Katie, great to be with you.
So affordability, it's always part of the conversation in any election cycle. But you think about affordability right now, especially when it comes to home ownership, when it comes to first-time home buyers, it's a particularly urgent question.
I would say it's the number one economic issue in the country. And when we talk about affordability, there's no bigger cost for the average American family than their home, right? Mm-hmm. And so housing really is driving this conversation. And I would say it drove our elections a month ago. It drove our elections a year ago. We called it an inflation election, but our inflation problem has been a housing problem for the last few years.
Probably a safe bet, too, to think it's going to drive our elections a year from now, too, when we get to those midterms. But talk us through the different dynamics here, especially when it comes to supply and demand, because one of the big narratives out there is that there's not enough housing supply to meet that demand.
Well, you've got three big things going on. We haven't built enough housing in this country since the Great Recession, so we have a supply gap. We're seeing costs go up dramatically, and that's not just the costs to build housing. It's insurance, it's utilities, it's labor, it's all the things that go into operating housing. And so it's become more and more expensive for homeowners to meet their monthly bills, even if they're already in a home, much less get into one. And it's true for renters, too, that the cost of maintaining rental housing has gone up dramatically. We've never seen an affordability crisis like this in the history of keeping the numbers.
With regards, though, to the solutions, where do those solutions come from? Do they come from the federal government, or do these need to be at the local level?
Yes, the answer is both.
All right,
Absolutely.
well, right now we have no HUD, as I'm sure you've noticed. That's been completely gutted. So let's take the federal government out of it. And let's talk about New York City. We have a new mayor that's going to be inaugurated at the start of the year. He ran on a campaign of housing affordability. He has some bold, if not controversial, ideas, particularly when it comes to protecting renters and particularly when it comes to, at least in his view, what he thinks he can do to force the building of affordable housing. Do you think he can do it?
Well, look, we're going to see. No. But one thing I was encouraged about is that on the day of the election, he announced that he'd supported a set of ballot measures here that are all focused on building more housing. Mm-hmm. It's one thing to talk about freezing the rent for people who already have housing. Mm-hmm. It's a different thing to try and say, how are we going to build more housing? How are we going to bring costs down? And that's what he's got to be able to do.
I want to just play devil's advocate here for a second, because I've had this conversation with a lot of folks. And one of the concerns with regards to a build out of more affordable housing, and I'm talking about properties that people would purchase, not rentals, this idea that as that supply comes in, you don't necessarily going to see a drop in overall prices, that effectively the market will rise up to a certain extent to meet that new supply, effectively keeping prices elevated?
Well, there's no question that it takes a while to build housing. And so you're not going to see it as an immediate solution. But in the long run, it's absolutely clear that we don't have enough housing. The estimates are somewhere between 3 million units and 7 million units that we're short. But everybody agrees that we have too little housing. And the laws of supply and demand do work.
But what's the incentive to build? I'm talking for private companies using their own money. Can this be done alone on their end, or do you need the federal government doing this?
Well, look, first we have to get government out of the way, right? And that means
out of the way.
That means less regulation.
Okay.
Zoning has to change. We've seen that happening in red states and blue states across the country. And so, for example, the governor of Montana, a very red state, got rid of most single-family zoning and parking requirements. We're seeing governors like Newsom get rid of environmental protections that are allowing more housing to get built. We're seeing New York City do the same thing. So that's part of it. But the government also has to play a strong role too. And here's the thing. When was the last time you saw Congress act almost unanimously on something?
I haven't seen Congress act at all on anything.
Well, here we go. This summer, they passed the biggest.
You know what? You know the last time they acted? Here's my joke. It was when you still had red hair.
That's a long time ago. So I won't take it personally.
Yeah, all right.
But look, here's and not enough is being reported on this, in my view. A few weeks ago, we had Tim Scott and Elizabeth Warren sponsor the most comprehensive housing bill we've seen in a generation, and it passed unanimously out of their committee. I'll say that again, unanimously. When was the last time you saw that? And this past summer, we saw the biggest increase in the low-income housing tax credit that we've seen in 25 years. That's 1.2 million units. So there is something the federal government can do. And I think what's unusual about this crisis, we've always had the problem here on the coasts, right? But it is everywhere in this country in a way that I've never seen. And that means it is more bipartisan. We just heard Michael Dell talking about the bipartisan interest in helping children, right? That is absolutely true on housing right now. And in a world where homeownership is disappearing as an option for building savings for more and more people, we've got to look at other ways to do that.
All right, Shaun, we're running out of time, but we have to get you back to, and I want to talk a little bit more with you at some point about enterprise community partners, but also this is an issue, as you know, having been at HUD years ago, that has persisted for a long time, and as Katie alluded to, probably going to be a big factor in midterm elections coming up in 2026. Shaun Donovan, the former HUD secretary under President Obama, now the president of Enterprise Community Partners. We'll be back in a moment. This is Bloomberg. We saw a lot of CEO turnover in 2024. So far in 2025, it's outpaced that by a mile, and it potentially could even be even worse in 2026. This is all being fueled by a mix of forces, including the rapid AI build-out, higher capital markets activity, and pressure, big pressure to deliver results. Our next guest has some findings out that suggest a careful transition is paramount, with poorly managed CEO changes erasing almost $1 trillion in market value every year. Vikram Malhotra is the senior partner at McKinsey, and he's the co-author of a new book called A CEO for All Seasons, Mastering the Cycles of Leadership. Pleased to say that Vic joins us here in Studio 2. Great to have you here.
Thank you for having me.
And particularly interested, not just in this book, but the previous book you wrote, and of course, everyone knows McKinsey historically kind of as the CEO factory, if you will, even if that's changing. It gets to this idea as to who actually is qualified to run a company in a day and age where things are changing so rapidly. Who knows what AI is going to do to us in a year or 2 years from now? So how do you even pick? If you're a board and you're trying to select your CEO for the next season, the next 5, 10 years, how do you go about that process?
I think from a board's point of view, you've got to think hard about CEO transitions well before they happen. I've seen the best performing boards thinking about it 3, 4, 5, 6 years ahead of when a CEO might transition, thinking about who's being groomed, who's being set up, and then in the moment, really making sure that the person coming into role has all the characteristics you want. someone who's bold around setting the direction, someone who understands organizational and cultural change, and who understands the context in the moment. The context changes over time.
Do you feel like companies are doing that in terms of that longer term planning? Because it seems like so many, at least some of the bigger companies out there, when you start to look at the tenure of their existing CEOs, and then you ask sort of what's the succession plan, and it's kind of like crickets. I know sometimes they don't want to reveal their cards, but you also feel like, well, what's the plan?
Yeah. Again, I would probably apply the 80-20 rule. In this case, unfortunately, 80% probably don't do it right. 20%, and these tend to be the best institutions and the best CEOs, do it very well. They really do spend the time and energy to kind of create the succession agenda, to kind of get the right people into place, to make sure that the board eventually has not just one, but 2, 3, potentially 4 people to choose from.
Yeah.
And they're creating the opportunities and making the room for the next generation of leaders.
And I know that, of course, when it comes to the board, succession planning is one of the most important things they have to do. But in a situation where a CEO is retiring, for example, how involved should that outgoing CEO be in succession planning, especially if you think that he or she is trying to think about their legacy as well?
Yeah. A CEO absolutely has a huge responsibility in the 2 or 3 or 4 years of lead up to their departure, in terms of creating a strong bench beneath them that the board can then pick from. But eventually it has to be a board-led decision. This cannot be the CEO anointing their favorite person or the person they believe is right. They may have a point of view on that, and they can share that with the board, but it's also incumbent on them to make sure that there are sufficient candidates internally. And of course, many boards appropriately also look externally as part of their due diligence.
Yeah, absolutely. And I do want to talk a little bit more about the title of your book, A CEO for All Seasons. We know that there's 4 of them. So just briefly walk us through, what that means in context of this book.
Yeah, absolutely. So we talk about it as stepping up. That's when you're getting ready to be a leader, a CEO. Starting strong, the first 3 years typically. Staying ahead, kind of the middle innings, and then sending it forward, and that's usually the last chapter. And each one of those seasons has some very specific things in the book that we highlight around what best practices are. We interviewed some of the best CEOs out there through a very rigorous methodology to kind of get their insights. But to me, the interesting thing was actually the 4 or 5 lessons that we saw across the seasons that were really quite interesting, which I'd be happy to highlight if you'd like.
All right, well, we're actually out of time, but we have to get you back for a longer conversation. This was actually a real fascinating book, and I should also point out your previous book that you had out on CEO excellence really kind of hits the nail on the head, but we talk a lot on the show about just how much more difficult it is now to run a company and the types of candidates needed to fill that role. Great to have you here, Vic.
Thank you.
Vikram Malhotra, senior partner over at McKinsey and co-author of the new book, A CEO for All Seasons, Mastering the Cycles of Leadership. That does it for me and Katie. We'll be back, or one of us, I think, will be back tomorrow here on The Close. But stick around. All of your politics coverage coming up at the top of the hour with Balance of Power.